problem, we're looking at a prior service cost. On January 1st, 2019, Smith Company adopted a defined benefit pension plan. At that time, Smith awarded retroactive benefits to its employees, resulting in a prior service cost that created a projected benefit obligation of $1,250,000 on that date, which it did not fund. Smith decided to amortize the prior service cost by the straight line method over the 20-year average remaining service life of its active participating employees. Smith's actuary has also provided the following additional information for 2019 and 2020. Service cost of 2019, $147, 2020, $153. 2. The expected and actual return on plan assets for 2020 is $33,000, and they have nothing for 2019. And 3. Projected benefit obligation, January 1st, 2020, $1,522,000. The discount rate was 10% in both 2019 and 2020. Smith contributed $330,000 and $350,000 to the pension fund at the end of 2019 and 2020, respectively. There's no other components of Smith's pension expense. So first, compute the amount of the pension expense for each year. Then prepare the journal entries related to the plan for each year. And then finally, there's this next level question. If the prior service cost was vested, explain how Smith's pension expense for 2019 would be different under the amended IAS 19. And so let's just start out, of course, with that requirement number 1. And we're going to start with the service cost. We'll add the interest cost. We will subtract out our expected rate of return. And this time we're also going to have the amortization of the prior service cost. And that'll give us the pension expense. So we have 2019 and 2020. The information gave us a service cost of $147,000. Then next it told us the actual rate of return for 2019 was nothing, so we'll just jump down and fill that out. Projected benefit obligation 1. Okay, that doesn't apply yet. The discount rate was 10%, so we can jump back up to our interest cost, and we have $1,250,000 times the 10%, and then our amortization of the prior service cost is going to be that $1,250,000 divided by the 20 years for $62,500, and then we'll do a sum. For a pension expense for 2019 of $334,500. So now for 2020, we have a service cost of $153,000. Interest cost, this time we can use the $1,522,000, so $1,522,000 times the 10%. We have an expected rate of return of $33,000. Our amortization is straight line, so that remains the same. And then we can pull our sum function over for a total expense of $334,700. And now we have that information. And we can do the journal entries required for 2019 and 2020. So we'll start out with a journal entry on January 1st for this 1,250,000. It's going to be debited to our other comprehensive income, prior service cost, and credited to accrued pension or prepaid pension cost. And let's make these comma style so we can see them better. Then on December 31st, 2019, I guess we really should have put 2019 with January. I'm gonna put it right here. Okay, December 31st, we have pension expense that we just calculated as $334,500. And we have cash of $330,000. And so we're going to have a difference that we need to make up for on the credit side. So we'll go ahead and put cash 330. And this difference will be credited to our accrued / prepaid pension cost. Then on December 31st, we also have to deal with the amortization. And so that's going to be debited to accrued prepaid pension cost and credited to our other comprehensive income for the prior service cost. And we calculated that amount previously as $62,500. And so then we need to do our 2020 journal entries. This time we don't have a January 1st because we only do that one time, so we can just go straight to December 31st. And we can really copy all of these accounts. Oops. Maybe I can copy all of these accounts. All right, so our pension expense for 2020 was $334,700. And the cash was $350,000. So this time the difference is actually going to be a debit balance. And so I'd really prefer that we switch places here and put the accrued prepaid next in the debit and then cash below that. So cash was $350,000. And the difference is debited into the accrued prepaid pension cost for $15,300. And then our second entry on the 31st for the amortization remains the same. So it's still going to be that same $62,500 because again, this was straight line. And then the third part is if the prior service cost was vested, explain how Smith's pension expense for 2019 would be different under the amended IAS 19. And so if the pension costs were vested, I guess we could just answer it up here. If the pension were vested, then the expense for the prior service cost would be the $1,250,000. Make that bold. And that's it for this one.